Do you expect there to be quite a bit of volatility either way if there is any kind of surprise whatsoever on Friday's payrolls?
We do. We also think that volatility is going to be a little bit higher in the rates market this year, simply because the Fed is so data dependent and there's still so much we don't know about next year. How will all these economic policies take shape? What will the impacts be? And so we do think that a very data dependent Fed in that context will just keep rate vol a little bit higher than it otherwise would have. Now, if we get the kind of number that Stephanie was talking about, if we see some softness in the underlying data, we do think that there's pretty good potential for rates to move quite a bit lower, largely because we think that there's so much good news that's priced into the market right now. There's so much optimism about U.S. growth remaining strong, about around elevated risk asset valuations, that if you start to see any wobbles in the economy, then we do think that there's a fair amount of a reassessment that's going to have to happen, and that should mean lower rates.
Do you think that that's the bigger potential surprise, is actually some weakness that spurs a rally just based on the positioning so far?
A rate rally, yes. Look, we generally perceive that right now optimism in the market is extremely elevated, and we've seen that over the last few months. There's a great deal of expectation that this is going to be a super growth-friendly administration, and that's that their scorecard is going to be the S&P, and that's essentially, we think, driven risk assets to very, very elevated values. Whereas we think that the range of outcomes next year is much wider. We don't know exactly what the policies will be. We don't know what the impact on the economy will be. And as a result of that, we think that there's a little bit of a mismatch there. Elevated optimism versus a very wide range of outcomes. And we do think that that should be supported for duration, at least in the early part of next year.
Stephanie, on policy, what assumptions have you made about policy changes from the incoming administration through the next year or so?
So for this year, we think it'll be mostly about deregulation, which is a positive for growth. The tariff thing is, of course, one of the biggest questions. We don't think that will happen until later this year, partially because they want to tie that to TCJA. And importantly, like Mark said, there's a ton of uncertainty when we're thinking about policy. But we think a lot of it's going to be relevant for 2026 rather than 2025. But it's not likely to be that stimulative, right? The TCJA is a $4 trillion tax bill that's going to be just keeping policy as is. It's just to keep policy largely steady. There's going to be a couple of things that could at the margin be growth positive, but then we have tariffs, which are a massive headwind.
Well, just on tariffs, are you saying that the primary objective of tariffs will be for revenue-raising purposes from the incoming administration? Is that what you're suggesting when you're saying the two will be tied at the end of next year?
I don't know if it's necessarily the primary objective. I think the primary objective is, Trump genuinely believes in tariffs, but then they do raise a lot of revenues, and that's something that they're going to need a whole lot of when they're thinking about this tax package.
Mark, you mentioned this, and I think it's important. Policy changes is one thing. Anticipating the economic consequences of them is quite another. It's not obvious to me how inflationary or not tariffs would be. Depends on how they're put together, how they're executed, whether you get retaliation. Also completely depends on what happens elsewhere in foreign exchange, investment decisions made by companies elsewhere that want to be in the United States and want exposure to the US economic story. What kind of assumptions can you make on changes and consequences?
I think it's really challenging for Stephanie and other economists. Look, our economists, I think, have done a very good job trying to dimension to the best of their ability what the key considerations are. But they'll be the first to tell you that the range of outcomes is extremely wide and that their confidence around these assumptions that they're making is extremely low. And you're right, Jonathan, there's so many other things that can impact the potential inflationary consequences of tariffs. Look at CNY overnight, right? It was 7.3. So you're starting to see the FX markets price some of this in. And to have a lot of confidence around what the overall economic outcome will be is, we think, it's very, very difficult at this point in time. Now, to be overly concerned around inflation, yes, some of these policies could indeed be inflationary. They were not terribly inflationary last time. And what we think the market should be spending a little bit more time is trying to think about, okay, well, what is the Fed's reaction function? Last time their bias was to look through any potential inflationary impact, or at least that's what the transcripts tell us. This time, of course, the macro backdrop is different. Core PCE is more elevated. We just went through a very inflationary period. So will their reaction function be the same? We don't know yet, but to me, that's what I'm going to be looking for to think about what the impact is to the bond market. And right now, my bias is still to believe, and our team's bias is still to believe, that the Fed's likely impact will be to look through to the extent that they can, especially if they start to see that tariffs have any type of negative growth impact. Finally, look, just to go back to some of the points that Stephanie made, I think they're really good. Just think about where the market narrative is right now and what Stephanie said. The policies are probably not going to be all that stimulative. Impact mostly in 2026, not 2025. Where is the market right now? look, you two talk to a lot of people. You'll know probably better than me. I talk to a lot of clients as well. I generally think that clients' mind frame is that these policies are going to be impactful near term and that they will be quite stimulative. And again, that's where we think market optimism is. Range of outcomes is a lot wider. And again, for me as a rate strategist, I think that probably means lower rates as you see some convergence in this.